Imagine waking up tomorrow, and the next Avengers movie is your call. Not your favorite theory about the plot, your decision, your budget, your release date. Across Marvel's enormous library, thousands of characters are sitting there, waiting for the right one to become the next billion-dollar franchise. That's the fantasy we're building today. Not because you can actually buy Marvel Studios. You can't. It's not for sale. And we're not pretending otherwise. This is a hypothetical ownership exercise. We're going to figure out what it would actually mean to control a business like this, what you'd really be acquiring, how the money moves, and the question everyone actually wants answered, what a business like this would even cost. Quickly, the real story. Marvel Studios is part of the Walt Disney Company, which bought Marvel Entertainment for about $4 billion back in 2009. Sony retains important Spider-Man film rights, while Marvel Studios and Sony work together under a partnership that gives both companies an economic stake in the films. Other Marvel characters, like the X-Men and Fantastic Four, only return to the fold years later through Disney's much larger acquisition of Fox. So, hypothetical ownership of Marvel Studios means the character library, the production pipeline, and the franchise economics sitting inside Disney's Marvel division today, not a standalone company anyone can walk in and buy. So, what are you actually acquiring? The audience sees superheroes. The owner sees an engine. A character gets introduced in a movie. That movie sells toys, video games, and a Disney Plus series. The series keeps the character culturally alive between films. That keeps demand warm for the next movie, which sells more toys, more games, more subscriptions. And the cycle spins again, off the same handful of characters, for decades. That's the Marvel flywheel. And it's the actual asset you'd be buying. The movie isn't the asset. The flywheel is. It's why Iron Man, a character created in the 1960s, is still generating billion-dollar decisions in a Burbank boardroom today. But the flywheel only spins for characters people already show up for. Marvel has thousands of characters on paper, but only a relatively small group have proven capable of anchoring a major franchise. Everyone else is inventory, not income. Let's start with the part of the engine everyone can see, the movie itself. Box office is the loudest number and the most misleading one. The MCU has grossed more than $30 billion worldwide since 2008, across dozens of films, one of the highest-grossing film franchises ever assembled, and a total that keeps climbing with every new release. But gross is not studio revenue. Theaters keep a real cut, especially early in a run, and international markets return less per ticket than domestic ones. And the trend matters more than the headline totals. Earlier Marvel releases generated enormous box office returns relative to their production costs. More recent slates have shown how quickly those economics can compress when budgets rise and audiences become harder to win back. So let's build a hypothetical model, and we're labeling it exactly that, hypothetical. Say a flagship film costs $200 million to produce, plus another $50 million to market, a combined investment of $250 million. It grosses $800 million worldwide. For our simplified model, we'll assume the studio ultimately receives 40% of that worldwide gross after exhibition and distribution splits. That's not a disclosed figure. It's a stand-in for what actually comes home after everyone else gets paid. 800 million times 40% is 320 million. Subtract the $250 million combined investment, and you're left with roughly $70 million of profit. And remember, we've only calculated the movie. We haven't even counted what the character earns outside the theater. That's where the rest of the engine kicks in. Licensing and merchandise, toys, apparel, games, park attractions. Throw off money without a single new frame of footage. Spider-Man has become one of the biggest superhero video game properties in the world, and Disney's new partnership with Epic Games is wiring Marvel characters directly into shared game worlds, a new spoke on the same wheel. Streaming can work a similar way. A Disney Plus series can create value even if its economics aren't judged like a standalone movie, because it can keep characters and franchises active between major releases. This is the layer that turns a decent movie into a multi-decade business. Now flip the model. Same $250 million combined investment, but the movie grosses $300 million instead of $800 because the franchise felt tired or the reviews were weak. At 40%, your simplified share is $120 million. Against your $250 million investment, you're roughly $130 million underwater. Before you even factor in the wider franchise damage a visible flop does to merchandise and streaming demand. One movie, $130 million gone. That's not invented drama. Release calendars have outrun audience appetite before, at Marvel and elsewhere. We've looked at what the movies make. We've looked at what they cost. We've looked at everything the characters can earn after the credits roll. But none of that answers the biggest question. What would you actually have to pay to own the whole machine? And now we get to the number that makes everything else look small. Disney has never sold Marvel as its own company, so there's no official price tag anywhere to quote. But analysts have tried to back into one. Forbes built an outside estimate using Marvel's share of Disney's box office over the prior decade, applied a multiple to its operating income, and layered in a share of Disney's value, landing on a figure of roughly $53 billion. Three things to hold on to here. That number is an outside estimate, not a company disclosure. It's dated to 2021, and it was never an actual asking price. Marvel has never been offered for sale at that number or any other. It also predates several major releases, including Deadpool and Wolverine, so treat it as a historical benchmark rather than a current valuation. Whatever a modern standalone valuation might look like, that 2021 estimate shows the scale we're talking about, tens of billions of dollars. And here's the uncomfortable part. A business generating tens of billions in theoretical value doesn't mean it generates tens of billions in annual profit. Valuation, revenue, and profit are three different numbers, and mixing them up is how owners talk themselves into overpaying. At an acquisition price measured in tens of billions, even a small financing cost becomes enormous. A hypothetical deal at this scale would almost certainly involve debt alongside equity, the way real acquisitions this size actually get financed. We won't invent an interest rate or a loan structure, that's pure guesswork. But here's the honest caveat. The $70 million of profit we calculated earlier is before debt service. Once financing costs are added, the amount left for the owner would be lower. The bigger the acquisition price, the more that gap matters. Before the final tally, sit in the fantasy one more time. You don't just own a studio building in Burbank. You own the engine, the pipeline that turns a decades-old character sketch into a toy aisle, a video game, and a theme park land, all monetizing the same underlying intellectual property. Most businesses have to invent something new every time they want to make money. Yours gets to sell the same idea again and again, as long as people keep showing up. So would owning something like this actually be worth it? Only at the right price. Owning the world's most valuable characters is incredibly powerful, but paying too much for those characters can turn even a great business into a bad deal. You wouldn't just be buying a studio lot or an office building. You'd be buying the right to keep telling the same handful of stories to a global audience that has already shown, for over 15 years, that it's willing to pay to hear them again. The physical assets were never the point. The idea was always the asset, and the real skill in owning it isn't creating something new. It's knowing exactly how many times you can sell the same idea before the audience stops buying.